Good afternoon and welcome to Biztech's Asian Midday Market Watch, brought to you by the Share Investor Group, providing stock market data and analytics, investor education, and online investor relations. Now it's Thursday and we have our regular Thursday guest, David Kuo, founder of the Smart Investor out of Singapore. Today, however, coming in from London once again. David, great to have you on the show.
It's sunrise over here in London, Brian. So salamat pagi, Brian.
No, but what is amazing is that you have such a bright disposition early this morning.
Well, I think you have to get up early in order to catch the market because there is so much going on right now, Brian.
Absolutely. So with that, I'm going to take a look at how crypto markets are performing. And then after that, we'll take a look at how regional stock markets have performed in the first half of the day. We've got Bitcoin, which is at 23,406. It's down 2.48%. Ethereum is at 1,848.18. It's down 2.56%. Now, looking across the regional stock markets, the SGX is at 3,280.95. It's up 0.56%. We've got Bursa Malaysia, which is down 0.07%. Shanghai is down 0.53%. The ASX All Ordinaries is down 0.46%. The Nikkei is down 0.89%. The Hang Seng is down 0.79%. And rounding up the numbers, we've got the Kospi, which is down 0.62%. I've said down a lot, David. Tell us why.
Well, you said down a lot apart from Singapore, because Singapore was up a little. And I think we can take some clues from what is going on in the markets. Singapore is up primarily because I think the bank stocks are holding up the Singapore shares. And the reason why the bank stocks are holding up those Singapore shares, I think, is on the back of those Fed minutes. And those Fed minutes that we'll be talking about very shortly is also driving down a lot of the markets in Asia. So I think in general, what we actually got yesterday was the Fed minutes from the July meeting. And people can read into those Fed minutes and walk away with whatever they want, because it was written in such ambiguous terms that some people said, oh, the Fed is being very hawkish and it is very concerned that it could over-tighten monetary policy and cause the US economy to go into recession. But on the other hand, the Fed says it has to keep on raising interest rates in order to stop people from anchoring on higher inflation expectations. In other words, it's got to break the back of inflation. And I think that is really what is driving the markets right now. People have suddenly realized that the Fed is not going to waver. The Fed is not going to get cold feet, and the Fed is not going to stop increasing interest rates because it knows that inflation is a problem. On that point, Brian, I mean, over here in the UK, we had the inflation numbers come out for the UK economy. Get this, over 10% inflation, right, over here in the UK. And people are very worried now because they're saying, my goodness, things are getting expensive. And consequently, the Bank of England is going to have to increase interest rates. And I think this is something that is going to happen all over the world. And all those people who think that, the central banks are going to come to the rescue, not this time, Brian.
I think they need to. And again, if you look at historically, especially during the 70s, if we don't lick inflation quickly, and I think that's the mindset of the Fed and many central banks around the region, if we don't lick inflation quickly enough, it's going to persist, and we don't want to have a decade-long period of stagflation.
Quite right. I don't think you can kick this can down the road any further, because there obviously are some people who are very concerned about higher interest rates. I mean, those households and companies that are heavily indebted, they're going to be very worried, because if interest rates do start to rise, it could impinge on their business models. Because if more of your cash flow is going to compensate or to actually sort of finance the loans that you have taken out over the last 10, 14 years or so, then there's going to be less left to reinvest in the business. And of course, those businesses are very, very concerned. But you're quite right. If you don't beat inflation, what is going to happen is that inflation is going to persist. So you have to ask yourself, would you prefer to have higher interest rates now in order to beat inflation, or are you happy to keep inflation keep on running up at double digits, 10%, 12%, in which case at some point in time the central banks are going to have to increase interest rates. So it's better to do it sooner rather than later.
Now, David, the other thing that happened and people were hoping for that is not going to happen this time is China coming to the rescue. Because in 2008, obviously, China came to the world's aid and basically dragged it out of that down cycle. But Nomura and Goldman Sachs have slashed forecasts of China's 2022 GDP even further. And Hong Kong and Chinese stocks are down today after profit warnings from Country Garden. So what's your take on this, particularly in the property sector, which you have cautioned before earlier in our shows during the year?
Well, I think there are lots of problems in China. I mean, first of all, we can have a look at the heavily indebted property developers in China. And then that sort of plays out to households, because households have actually thought that property prices in China can only go in one direction, upwards, but they're beginning to see that that doesn't always happen, and property prices can fall at the same time. Then they have the secondary problem of the COVID strategy, which doesn't seem to be working. Then you have the third problem, which is heat waves in a certain part of China as a result of climate change. So when you put all of these things together, it is not really that surprising that Goldman has cut China's GDP forecast for this year to around 3%, and Nomura has cut it to below 3%. So I think China's economy is going to go through a period of pain, and they have to decide what they want to do, Brian. I mean, everybody can look at China and say, we know where your problem is. Your problem is in this COVID zero strategy that you have. Let's put that to one side, try and vaccinate as many people as you can with a vaccine that works, and then hopefully you'll be able to turn around the economy. But if you just keep on sticking to this zero COVID strategy and lock down parts of the country whenever you find that there is a rise in COVID cases, you are not going to be able to sort of solve your economic problems. This is a health crisis in China, and it is compounding now to becoming an economic crisis.
Now, David, on a third note, Australian unemployment data came out and it fell to 3.4% in July, the lowest since 1974. Now, it was 3.5% in June. So this seems counterintuitive to an economy that is going into recession.
Well, this is a case of good news being bad news, Brian. Yes, you're quite right. Unemployment rate is now at a near 50-year low in Australia. So therefore, it means that they have good job prospects for everybody in Australia. But unfortunately, because you have this sort of high employment level in Australia or low unemployment levels, it therefore means that companies will probably have to pay a little bit more to get the labor that they require. The problem then is, what do you do with inflation? Inflation in Australia is running at around 6%. So if it suffers the same problem as the rest of the world, high inflation, the Reserve Bank of Australia will have no choice but to increase interest rates. And if they do increase those interest rates, that is the reason why you're sort of seeing the Australian share market falling today. So it really means that because there are more people in work, you're going to have to pay more for that labor. That is going to fuel inflation. And in order to correct that sort of inflationary pressures, you're going to have to increase interest rates. It is not a nice problem for any central bank to have, but I don't think they have any choice but to try and jack up those interest rates above what they are at the moment, which is not sufficient to keep a lid on inflation, Brian.
Now, David, as always, thank you very much for taking your time to come on the show, and thanks for your insights.
Thank you.
Now, I'm Brian Fernandez, and we've been speaking to David Kuo, founder of the Smart Investor out of Singapore, on Biztech's Asian Midday Market Watch. For all of you that are in Singapore, you will be able to catch David at Invest Fair by Share Investor, which is happening physically at Suntec Convention Hall 404 in Singapore on Saturday, August the 27th from 9 a.m. onwards. It's free to attend and features 18 investment experts. You can sign up today at investfair2020.com. Please subscribe and like our various platforms. Thanks again for tuning in.